Well, Barron's this weekend caught our eyes saying that real estate investment trusts are sending a powerful buy signal. Is it time to buy the REITs?
Let's ask a couple of experts in that area. Robert Stevenson is head of real estate research at Janney, and Todd Bradell is CEO and CIO at Center Square, which is a real estate investment firm. Puts his money where his mouth is. Bob, what do you think? What did you think of that article? I mean, the REITs are down 10%. Rates are going up, so that makes sense. But is it time to buy some of these right now? What do you think?
Well, look, I mean, as you mentioned in the lead-in, REITs are down about 10% year-to-date, underperforming the S&P 500 by about 1,200 basis points. You know, investors have just basically abandoned the REIT space off of higher interest rates, believing that you're not going to get the growth and you're not going to get, you know, enough investment-wise to stay in the names, despite some very hefty dividend yields. And so, you know, if you're looking for 10, 12, 20% earnings growth in 2018, you're not going to get that out of the REITs. But if you're looking at, you know, 5, 6, 7, 8%, even almost 10% dividend yields, where the dividends are growing to make up for inflation, and you have leases that adjust for inflation, REITs are not a bad deal.
But Bob, why is the case? And you mentioned some more conservative ones that might be First Industrial, National Retail, Realty Income, but why does City Office have an 8.8% dividend yield? I mean, what are the concerns that any investors there should be fully aware about before just thinking they can collect a hefty yield like that?
Well, I mean, when you're talking about sub-billion-dollar names, what you're really talking about is retail-focused and smaller institutional investors, and those are the people that have fled the REIT space in masses. And so when those guys aren't buying, it's hard to find a home for some of the smaller names that don't have the liquidity that somebody like Todd may need in order to buy in size. And so, you know, that's one of the places where you're finding the most beat-up names, you know, possibly some of the best bargains out there. You're getting almost a 9% dividend yield at City Office with decent valuations there.
So, Todd, where would you put new money to work? If so, where? Is it sector-wise? Is it geographic? You know, what would you do here?
Well, I agree with some of Bob's points as well, and I think we are putting new money to work and have a pretty bullish outlook for the REIT sector at this point in time. And you know, what's been driving investors away from REITs is basically the attraction to other sectors and, you know, some of the other FANG stocks that have been out there. But where we're putting new money in particular is really following two major themes, one of which is obviously the technology trends that are driving the REIT sector, you know, some aspects of the REIT sector, which I'll explain in a second, and then the second is demographics. So from a technology side, you know, data centers, the cell tower REITs are definitely growing and continuing to grow, you know, benefiting from, you know, technology advancements and the need for data centers. And secondly, from a demographic perspective, you know, millennials are starting to look for things other than just urban housing. And to that end, we've been investing in some of these single-family housing REITs that are out there, which really cater to a for-rent model, but in the suburbs.
Just to be clear on that, Todd, it sounds like you actually are not a big fan of multifamily REITs then. Maybe even, you know, some of the more traditional kind of mall or retail names. You're talking about cell towers. You're talking about single-family REITs, which, you know, again, is not what most people think of when they think about the sector, right?
Yeah, I think the multifamily space basically has been experiencing effectively urban development that it hasn't experienced in a while. We actually anticipate that sometime toward the latter part of 2018, that the supply of multifamily assets in urban markets will actually begin to decline, which is actually going to set up a very, very nice 19 for both multifamily REITs and for office REITs as well. So the supply picture is going to get a lot better for REITs going forward.
Bob, I was fascinated in your notes, your thoughts on traditional malls and shopping centers. I mean, we all know what's going on in retail these days. I can remember when malls were starting to come into fashion. Are we witnessing the end of an era here with a lot of these malls going out of business?
Well, I think that you're definitely seeing a secular change, not a cyclical change. And, you know, it's going to be very important for retail to be invested in the higher quality names. Higher quality, top 30 malls, I think, will wind up being here, you know, 10, 15, 20 years down the road. The lower end of the spectrum is where I think that you see very big vacancies and tenant issues. And those are going to be repurposed as indoor sports arenas, Gold's gyms, and rock climbing walls, among other things out there. But,
fun.
it's one of the sectors we've been staying away from, and we'll let others call the various bottoms there, because it's just, from our standpoint, is that there's just not a lot of good news coming out of those spaces these days. We'd rather be in the industrial guys like First Industrial.
Yeah, Bob, and you had some good picks there. Todd, real quick in a word, any particular REIT that you'd be recommending right now?
So we like the ones that I mentioned in terms of the sectors. We don't mention specific names, but on the retail space side, I would say that the M&A activity that took place in the fourth quarter is providing a significant bottom to the retail space today.
Oh, that's right. A lot of consolidation potentially at play.
A lot of consolidation.